On September 15, 2008, you woke up and the world was different. You did not know it yet. You were making coffee, getting dressed, maybe dropping your kids to school. But while you were doing all of that, the largest bankruptcy filing in the history of human civilization had just happened. $613 billion gone in one night. And within weeks, your neighbor lost his job. Your cousin lost her house. Your parents lost 30% of their retirement savings. 8 million Americans lost their jobs. 10 million Americans lost their homes. And the men who caused every single bit of it walked away with hundreds of millions of dollars in their pockets. This is the story of Lehman Brothers. And once you understand what really happened, you will never look at a bank the same way again. Before we go any further, here is something that will make your blood run cold. The people who ran Lehman Brothers knew. They knew the bank was dying. They knew the risk was catastrophic. And in the final months before the collapse, while ordinary investors and pension funds and retirement accounts still held Lehman stock, the executives at the top were quietly moving their own money out. They saved themselves. They did not save you. Lehman Brothers was not born on Wall Street. It was born in a small dry goods store in Montgomery, Alabama in 1844. Henry Lehman, a German Jewish immigrant, opened the store to sell groceries and supplies to local farmers. His brothers Emmanuel and Meyer joined him, and together they built something remarkable. They began accepting cotton as payment from farmers who did not have cash. Then they started trading the cotton itself. Then they started brokering other commodities. And slowly, over decades, what had started as a tiny store in Alabama transformed into one of the most powerful financial institutions in the world. By the time Lehman Brothers collapsed in 2008, it had survived the Civil War, 2 world wars, the Great Depression, and over a dozen financial crises. It had existed for 158 years, and it was destroyed in approximately 18 months by the decisions of a small group of men who chose greed over every lesson that 158 years of history had tried to teach them. To understand how Lehman died, you need to understand one word: mortgage. Specifically, the American mortgage market in the early 2000s, which had become something so reckless, so deliberately blind, and so catastrophically leveraged that in retrospect it seems almost impossible that intelligent people did not see the disaster coming from miles away. Many of them did see it. They chose to look away because looking away was making them extraordinarily rich. Here is what happened in the American housing market in the years before 2008. Interest rates were low. Money was cheap. Banks were lending to anyone who wanted a mortgage, including people with no income, no job, and no assets. These loans were called subprime mortgages. They were given to people who could not realistically afford them, often with low initial interest rates that would later balloon to levels the borrowers could never pay. The banks that made these loans did not care whether the borrowers could repay them, because the banks were not planning to hold the loans. They were planning to sell them. Wall Street had developed a system for turning these mortgages into financial products called mortgage-backed securities. A bank would bundle together thousands of individual home loans, package them into a single security, and sell that security to investors. The investors would receive payments derived from the mortgage payments made by homeowners across America. The rating agencies, the companies whose entire job was to tell investors how safe these securities were, gave many of them their highest ratings. AAA, the same rating given to United States government bonds. The safest possible investment. Except they were not safe at all. There were bundles of loans made to people who could not afford them, rated as safe by agencies that were being paid by the same banks that were creating the products being rated. The conflict of interest was so obvious, so naked, and so completely ignored that it remains one of the most damning indictments of an entire system ever documented. Lehman Brothers did not just participate in this system. Under its CEO Richard Fuld, Lehman became one of the most aggressive players in the entire mortgage market. Fuld had run Lehman since 1994 and had transformed it from a struggling firm into a genuine Wall Street powerhouse. He was intense, competitive, and completely consumed by the desire to make Lehman the biggest and most profitable firm on the street. Employees called him the gorilla. He called himself the gorilla. He wore it as a badge of honor. And in the booming mortgage market of the mid-2000s, Fold pushed Lehman harder and faster than almost any other firm on Wall Street. Lehman did not just buy and sell mortgage-backed securities. It went a step further. It started buying actual real estate directly. Apartment buildings, office towers, commercial properties. It borrowed enormous sums of money to finance these purchases, a strategy called leverage. At its peak, for every single dollar of actual equity Lehman had, it had borrowed and invested $30 more. 30-to-1 leverage. This meant that if the value of Lehman's investments fell by just 3%, the firm's entire equity was wiped out. Every dollar of actual shareholder value gone. And in 2007 and 2008, American real estate did not fall by 3%. It fell by 30%. It fell by 30%, and then 40%, and in some markets, more. The warning signs came early. In 2007, two hedge funds, run by Bear Stearns, another major Wall Street bank, collapsed because of bad mortgage investments. The market shuddered. Experts warned that the subprime mortgage market was in serious trouble. Rating agencies quietly began downgrading some of the mortgage securities they had previously rated as safe. And inside Lehman Brothers, a small number of executives raised alarms internally. They prepared presentations showing the scale of Lehman's exposure to the crumbling real estate market. They brought the numbers to senior management, and they were told, in various ways and at various times, to sit down and be quiet. One of the most damning moments in the entire Lehman story involves a woman named Eileen Applebaum, and more specifically, a series of internal risk managers who identified the problem clearly and were systematically overruled or ignored by the people above them who did not want the party to stop. The bonuses were too big. The momentum was too powerful. And Richard Fuld, the man at the top, believed with a certainty that proved catastrophic that Lehman was too important, too well connected, and too central to the American financial system to ever be allowed to fail. He believed, right up until almost the very end, that if things got bad enough, the United States government would step in and save the firm. He was wrong. By early 2008, Lehman's stock had begun to fall sharply as investors grew increasingly nervous about the firm's massive real estate exposure. Fuld went on television and gave interviews, projecting confidence. He told analysts and investors that Lehman had more than enough capital to weather any storm. He said the worst was behind them. Meanwhile, internally, Lehman was doing something that a later bankruptcy examiner would describe as a massive accounting fraud. It was called Repo 105. Repo 105 was a mechanism that Lehman used to temporarily remove tens of billions of dollars of toxic assets from its balance sheet at the end of each financial quarter, just long enough to publish quarterly financial statements that made the firm look healthier than it actually was, and then bring those assets back onto the books after the statements were published. In simple terms, Lehman was hiding its debt from investors every 3 months, showing the world a cleaner balance sheet than the real one, and then quietly bringing the mess back home when no one was looking. At its peak, Lehman used Repo 105 to temporarily move approximately $50 billion off its books. $50 billion of toxic assets hidden every quarter, while investors made decisions based on financial statements that did not reflect reality. The bankruptcy examiner who uncovered this practice concluded that senior Lehman executives, including Fuld, either knew or should have known about it. Fuld has maintained that he was unaware of the specifics. No senior executive was ever criminally charged for Repo 105 through the spring and summer of 2008. As the American housing market continued its collapse and as Lehman's stock price continued to fall, Fuld and his team worked frantically to find a buyer or a rescue partner. They held discussions with Korean investors. They talked to Bank of America. They reached out to Barclays, the British banking giant. Every conversation went nowhere. Potential buyers looked at Lehman's actual books, the real ones, not the Repo 105 versions, and walked away. The hole was too deep. The toxic assets were too numerous. The losses were too large. In September 2008, Treasury Secretary Henry Paulson and Federal Reserve Chairman Ben Bernanke convened an emergency meeting of the heads of the largest financial institutions in America. The message was stark. Lehman Brothers was going to fail, and the government was not going to bail it out. The assembled bankers were told to find a private sector solution. They spent a frantic weekend trying. Barclays was the most serious potential buyer. A deal seemed close. And then British financial regulators intervened, refusing to approve a transaction of that scale without a shareholder vote that would take months. The deal collapsed on Sunday evening. There was nothing left to try. On Monday, September 15, 2008, at approximately 1 in the morning, Lehman Brothers filed for bankruptcy. The filing listed $613 billion in debt. It was, and remains, the largest bankruptcy filing in American history. When markets opened that morning, the reaction was immediate and global. Stock markets around the world crashed. The Dow Jones Industrial Average fell over 500 points in a single day. Credit markets, the systems through which companies borrow money for everyday operations, froze almost completely. Businesses that had nothing to do with mortgages or real estate suddenly could not access the short-term financing they needed to make payroll, to buy inventory, to keep their doors open. The infection spread from Wall Street to Main Street with terrifying speed. Within days, the American International Group, the insurance giant known as AIG, which had insured trillions of dollars of the same toxic mortgage securities that had destroyed Lehman, was on the verge of collapse. The government stepped in to rescue AIG with an $85 billion bailout, a decision that sparked outrage across the country. Then came the rescue of mortgage giants Fannie Mae and Freddie Mac. Then the Troubled Asset Relief Program, the $700 billion government bailout package that Congress barely passed. After an initial rejection, it caused a further market collapse. The total cost of the financial crisis to the American economy has been estimated at over $22 trillion when you account for lost economic output, lost wealth, and the cost of government interventions. $22 trillion. Because a handful of men on Wall Street decided that the rules that existed to prevent exactly this kind of catastrophe were inconvenient obstacles to their bonuses. The human cost is harder to calculate than the financial one, but it is the one that matters most. 8 million Americans lost their jobs in the recession that followed the financial crisis, the worst economic downturn since the Great Depression. 10 million Americans lost their homes to foreclosure. The median American household lost approximately 40% of its net worth between 2007 and 2010. Black and Hispanic families, who had been disproportionately targeted by predatory subprime lenders, lost the highest percentages of their wealth. Community organizations and charities that had invested their endowments in what they were told were safe securities found themselves unable to fund the services that desperate people needed more than ever, precisely because the financial crisis had made so many people desperate. The cruelty of the timing was total and complete. Richard Fuld testified before Congress in October 2008. He was asked directly whether he felt any personal responsibility for what had happened. He said that he had made decisions based on the best information he had at the time. He said that he deeply regretted the outcome for employees and shareholders. He said that he had never intended for any of this to happen. A congressman held up a piece of paper showing that Fuld had received approximately $480 million in total compensation in the years leading up to the collapse. He asked Fuld whether he thought that was fair. Fuld disputed the number. The exchange became one of the most watched moments of the entire financial crisis, not because it resolved anything, but because it captured perfectly the gap between how the people who caused the crisis understood what they had done and how everyone else understood it. No senior executive from Lehman Brothers or from any of the major banks whose recklessness contributed to the 2008 financial crisis was ever sentenced to prison for their role in the catastrophe. A small number of lower-level employees were prosecuted. The major banks paid enormous fines, billions of dollars in settlements with regulators and shareholders. But the money came from the banks themselves, which meant it came ultimately from shareholders, not from the individuals who had made the decisions. The men who ran these institutions into the ground and took the global economy with them largely continued their lives in comfort. Some started new firms. Some joined corporate boards. Some gave speeches at financial conferences. The system that had failed so completely closed ranks around the people who had most profoundly failed within it. The 2008 financial crisis permanently changed the relationship between the American government and its largest financial institutions. The Dodd-Frank Wall Street Reform and Consumer Protection Act was passed in 2010, the most significant financial regulation since the reforms that followed the Great Depression. It created new oversight mechanisms, new capital requirements for large banks, new rules around derivatives trading, and a new consumer protection agency. Whether these reforms are sufficient to prevent another crisis of similar scale is a question that economists, regulators, and historians continue to debate. What is not debated is that the crisis revealed something fundamental about the American financial system that many people had suspected, but few had been willing to say directly. The system was not designed to protect ordinary people. It was designed by and for the benefit of the people at its top. And when those people drove it off a cliff, ordinary people paid the price, and the people at the top were largely insulated from the consequences of their own decisions. Lehman Brothers, the firm that Henry Lehman built from a dry goods store in Alabama, that survived wars and depressions and a century and a half of financial history, was killed in 18 months by leverage, by greed, by accounting tricks, and by the absolute certainty of one man that he was too important to fail. He was wrong about that, but he was right about one thing. When the failure came, it was not him who paid the ultimate price. It was the 8 million people who lost their jobs. It was the 10 million people who lost their homes. It was the retired teacher who lost her pension, and the young family that lost the down payment they had spent 5 years saving. Those were the people who paid for Richard Fould's certainty, and not one of them had ever set foot on the 31st floor of 745 7th Avenue, where the decisions that destroyed their lives were made. This has been American empires. If this story made you angry, it should. Subscribe, because next time we are going inside WeWork, the startup that convinced the entire world it was worth $47 billion by renting out office space and calling it a revolution. The story of Adam Neumann, the most charismatic fraudster in Silicon Valley history, and the investors who handed him billions of dollars without ever asking a single serious question. That episode is coming very soon. Until then, remember, empires rise, empires fall, and the truth, no matter how long it takes, always survives.